Good morning. It is Thursday, May 7th, 2026. Global markets are bracing for a pivotal morning as we await the 8:30 a.m. initial jobless claims report. Futures for the S&P 500 are holding steady near the 7,200 mark, reflecting a market caught between robust AI-driven earnings and a complex geopolitical backdrop. With energy exports hitting record highs and the Fed maintaining a cautious stance, the opening bell today carries significant weight for macro sentiment.
The macro narrative right now is dominated by the hawkish hold we saw at the late April FOMC meeting. The Fed funds rate remains at 3.5 to 3.75%, but the four dissents at that meeting, the most since '92, suggest internal pressure is mounting. While Neil Kashkari and Beth Hammack represent the hawkish wing concerned about energy-driven inflation, we're watching if today's productivity and labor cost data can provide any cover for a potential late-year pivot. Turning to the indices, the S&P 500 has reclaimed much of its early year losses, outperforming the rest of the world by nearly 10% since March. The U.S. exceptionalism trade is back, fueled by energy independence and a technology sector that remains the epicenter of the global AI investment cycle. However, with crude oil up 60% since the start of the Iran conflict, the market is highly sensitive to any shift in energy supply chains as we head into the second half of the year. Correct. And it is important to note the shift in fixed income. The 10-year Treasury yield is hovering near recent highs as inflation expectations reprice. One-year inflation swaps in the U.S. have jumped by 75 basis points recently. For investors, the play has been duration light, favoring U.S. large caps that can weather higher for longer rates. We are seeing a terms of trade shock that actually benefits the U.S. due to our vast energy resources, a stark contrast to the pressure currently felt in European and Asian markets. As we count down to the bell, keep an eye on the 20,000-50,000 forecast for jobless claims. A beat there could reinforce the Fed's patience, while a miss might spark concerns about a labor market growth undershoot. We're also tracking NVIDIA ahead of their May 20th report, as AI infrastructure spending continues to be the market's primary stabilizer. Stick with us as we navigate the opening cross in just a few minutes.